Well, one of the key questions is this monetary medicine. Will it affect the outbreak and the economy? That's more debatable, but certainly it does provide a backstop, along with many other central banks that are likely to follow suit, in providing some support for the fixed income markets and generally financial risk in terms of sentiment.
How much further easing are you anticipating from the Fed? Because there's been a lot of talk about perhaps a follow-up 25 basis point cut in just a couple of weeks' time, and then another one in April.
Well, certainly the market's got to the tune of around 60 basis points in addition to that 50 basis point emergency move we saw earlier this week. Our view is that they will nudge further down, 25 basis points in the next subsequent meeting on the 17th and 18th of March, but then hold powder dry thereafter. But I do think it needs to be put in conjunction with other central banks, with the prospects of, at least in terms of language, by Bank of England, ECB, and numerous EM central banks too, suggesting that they're going to provide either policy rate cuts and a combination of liquidity operations too. So it's a collective package, it's not just the Fed, even if they're leading the way.
Right. What do you expect then on the EM front? We were talking about this in the last hour of the program. Of course, we had Malaysia easing 25 basis points earlier on this week. What's next? How aggressive do you think the easing will be in the EM space?
Well, ahead of this, we already saw EM central banks, even when the Fed was on pause, cut rates reasonably aggressively, latter stage of last year and early this. This is just going to accelerate. Now, I'm hesitant to say scheduled meetings because we could get intermeeting moves, as we've seen in terms of precedents of the Fed. But scheduled meetings are the likes of the Philippines, Indonesia, Thailand for this particular month, and they could easily deliver some form of policy easing. But to me, it's a question of whether this starts to provide some relief in terms of capital flows. One of the dangers, you mentioned about foreign exchange in terms of EM, one of the dangers if there's extended FX weakness and indeed restrain some of that monetary policy response, as we've seen in past periods of volatility. I don't think that's the case this time around. So as long as there's orderly reductions in rates and it doesn't adversely affect the currencies too much, then this should be favourable for fixed income, in particular EM rates.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.